Okay, it's a little bit after the hour. I think maybe I can get started. It's 11:02. We'll go ahead and start the webinar. We've got people lined up, and so we're happy that people are joining us at this time. So I'll go ahead and start with the welcome, and those of you who are just coming in, thank you for jumping on. First of all, just good morning, everybody. Welcome, everyone, to today's virtual double crop farmers webinar. Oops, and I want to make sure I'm not muted, right? Okay, everybody hearing me? Give me a thumbs up there. Okay, I guess I am. Okay. Thank you for joining us. This is an educational opportunity provided by the Illinois Wheat Association in partnership with the Illinois Soybean Association. This is the third webinar in a four-part series that constitute this year's virtual double crop forum. Our final seminar will be in 2 days, Thursday at 11 o'clock. I want to mention also that if, for those of you who are interested, you can earn CEU credits for sitting through this webinar and participating in the Q&A session at the end. That will be done through an IRC code that will be shared on the screen at the end of this webinar time in approximately 50 minutes or so. I am Mike Doherty. I'm the Executive Director of the Illinois Wheat Association, and I will be moderating today's webinar. At this time, please allow me to thank our staff and our support network that makes this possible, particularly Charlene Blairy, our longstanding administrative assistant for Illinois Wheat Association, also Illinois Soybean Association staff, Stefan Sostarik, who is our IT specialist behind the scenes today, and Claire Weinzierl, a communication specialist with Illinois Soybean Association. She's standing by, and Claire will be monitoring the Q&A box, and we'll be looking for your questions and kind of organizing those to be handled at the end of our guest speaker presentation. At this time, I want to thank our sponsors. We have both platinum and gold sponsors for their contribution to the virtual double crop forum. Our platinum sponsors are AgriMax Seed Company in Southern Illinois. They are our high performance wheat seed company. ADM, which in the last couple of years opened a new plant up in Mendota for wheat milling. Corteva AgriScience, which many of you know, large-scale supply company, and Illinois Farm Bureau, which provides overhead and housing for the Illinois Wheat Association. We also have a group of gold sponsors. I'm going to make sure I move my, there we go, move myself over a little bit. Our gold sponsors are FS Inspire and their wheat seed product, Central Life Sciences, and last but certainly not least, Seymour Milling, who have a wheat mill in Teutopolis, Illinois, and they are a long-term supporter as well of Illinois Wheat Association, and we really thank them for the continuing support. At this time, I'd like to go ahead and introduce our guest speaker for today. Our guest speaker is Guy Allen, who is the senior economist for the Kansas State University's International Grains Program. Mr. Allen comes from an Illinois farm family with relatives involved with agriculture here in our state. He not only works with international groups of farmers, but he also has his own farming operation in Australia, I came to find out. So it's a small world there, as I have relatives in Australia. And all these experiences have given Mr. Allen a very broad perspective and a deep perspective on the global wheat supply and demand channels and dynamics of how wheat is marketed and how it is priced. So at this point, I'm going to turn the webinar and the screen over to Mr. Allen. Take it away, Guy.
Thank you for that introduction, Mike. Appreciate that. Always coming back to my roots. Just a footnote there. I've got over 30 years of international experience in the commodities trade, predominantly in Australasia, spending some time in 3 years in China as well. So it's boded me very well, I guess, in this current environment where China's driving a number of these commodity prices and complexes there. So I might get into the presentation. There's a lot to cover today. I may travel fairly quickly. Hopefully leave a lot of time for questions at the end. Always like a question and answer situation. That way we can focus down on what you're most interested in. So I'll get the screen shared here. And I'm assuming that's working appropriately there, Mike.
Yep, we can see it. You're good.
All right, very good. Okay, moving on. What I want to cover quickly today is I always like to start off these presentations and overviews talking about the macro events. There's an awful lot of different major issues driving these commodity markets today. And in 30 years, I don't know if I've seen such a plethora of issues driving the commodity markets. One thing I want to focus on is the growing US dollar money supply and how that's impacting interest rates and commodity prices. I want to start then going over the world wheat situation outlook and drill down the US a bit. Then I want to talk to both soybeans and corn. Soybeans with the double crop situation, and appreciate the sponsorship from Illinois Soybeans. And then probably spend a bit of time on corn, because I'm sort of the view corn's the big unknown factor. And as we're going into spring planting, all these commodities, as well as I'll throw grain sorghum in there as well, are really competing fairly tenaciously for your planted acres this coming spring. So there's going to be some intercommodity relationships there. They're going to have to sort themselves out in the next coming weeks. I'd have to say at the moment, soybeans are really dominating the situation. And then if we've got time at the end, I might drill down on some more specific China issues there. So just running around the world quickly, looking at the macro issues. One thing I want to talk about is the dollar. We've had significant printing of US dollars in this COVID stimulation money that's being spent over the last 24 months. And that's definitely driving the economy. The prevailing COVID situation and its impact on the global economic situation. Changes in US policy. We've had a change in administration, a bit of a dichotomy in the way different people view the world, and we're probably going to see some changes in trade and as well as foreign policy, and that's going to be key as well. And highlighting that, and at the center of that is US-China trade issues and its bigger picture relationships as it comes down to South China Sea situation. Don't want to forget the African swine fever. We're recovering from that. That's driving the situation for both corn and soybeans, and it's definitely is having an impact on wheat. We've got an evolving situation with a new bird flu strain outbreak, and that's across India, parts of Europe, and Korea. And whenever there's a animal health issue in this intensive animal agriculture situation, it definitely has a market impact. You've been reading a lot about South America, Brazil, and as well as Argentina. We've had dry weather down there, particularly in southern Brazil and Argentina, as well as their currency situations are impacting their relative values of commodities down there. In a local real or Brazilian or Argentine peso situation, we have record high commodity prices in those countries in their local currency. Argentina is also discussing an export tax that's likely to come on, and that's sort of been wavering on both sides of the coin. So we'll see that as that evolves. And I'll talk to that situation a bit. Also, export taxes coming out of Russia. Keep in mind, Russia is the largest wheat exporter today. And interesting dynamics happening across the Ukraine, those Black Sea exporters, as well as increasingly in Europe. Speaking of Europe, the UK-Europe Brexit situation, there's a trade agreement there to be finalized and negotiated, which will have some impact on the commodity prices. A key factor, particularly as we look at the export situation, is going to be ocean freight, and our ocean freight rates have gone up quite significantly in the last 3 months. And there's also been a shortage of availability of containers, and that's starting to impact export prices, particularly for the buyers trying to procure U.S. exports. Dry weather in Malaysia, Indonesia has been driving palm oil prices and the soybean and oilseed complex as palm oil production has dropped off and people shift to other vegetable oils. And the recovery, we've had 3 years of drought in Australia. We've moved to nearly a record wheat production this year. So from a wheat situation, we're going to see competition from the Australians, and that's generally higher quality, mid-high protein wheat. Generally, it's into Southeast Asia, Middle East, and it's, if you're a higher protein, probably more of a hard wheat or a spring wheat producer, it has a bigger impact on the market situation there. So just as I said, I want to talk about this foreign exchange situation. We've seen a significant weakness in the US dollar over the last 6 to 8 months. We're down approaching near to three-year lows on both sides of the 90 mark there, and I continue to expect that to go lower. The interesting thing, the dollar is losing value against most currencies, and the other currencies, they're in a relationship staying pretty much stable. But this is I guess a big worry or concern for myself. Just to put it in perspective, this is the M2 money supply going back 25 years, about 1985. And you can see we've increased the money supply in the last 12 months by nearly 25%. And a big jump in money supply. Effectively, we go back to the global financial crisis, 2007 through about 2010, where we saw a deliberate quantitative easing to stimulate the economy. In that situation, that's just a little bump on this continuous graph, and you can just see the scope and that big historic jump in the money supply. The big difference is this is sort of where that money is going, and where it seems to be going at the moment is in the mortgage-backed securities, and that's why we've seen a good rally in housing prices and why lending staying cheap, and also in the purchase of long-term treasury note purchases, which is quite a different mix than what we saw back in 2007 and 8. What this is doing is it's changing the relative value of the US dollar, and this is why I continue to see that value of the US dollar continue to drop. That's good for exports, that's good for commodity prices. It's going to make some inputs a lot more expensive, but it's just something we need to keep an eye on. It also has the potential to drive inflation and then later drive interest rates. And myself, as well as most of us out there, are probably old enough to remember the late 1970s sort of boom, and then the resulting inflation and the double-digit interest rate situation that we saw in the 1980s as we tried to get that under control. You know, my colleague here in the Ag Econ department, these are sort of his notes here. He's not as worried about it as I am. I'd also say he's probably not as old as I am and has a different historical perspective. But as long as inflation isn't high, interest rates will stay relatively low. And a lot of people, probably more informed than I am, aren't necessarily expecting to see that interest rate or the inflation come in as quickly, but I'm a bit skeptical of that whole situation. And it's going to have a bottom line impact on commodity prices. This is going back in longer term chart. I put that just up there for interest. This is the debt according to GDP. Right now, our debt's probably about the same as our annual GDP, and it has the potential to double that going forward in the next 10 years or so, which would be a real concern if interest rates increase. Okay, turning now to talk about wheat. This is the world. I put most of the numbers up today in a balance sheet format rather than a graph. Wheat's been sort of a follower. We're looking at a world wheat production this year at 772 million metric tons. It's down month on month in the January USDA report, but it's still a record global wheat production. And you're going to hear that record production, quite a few through this, because we just have significant volumes of grain around the world, even though things are tight. The good thing on that, we're seeing record demand for wheat, both in consumption. Consumption kind of grows with the population. it's fairly inelastic, but we're seeing definitely an increase in wheat feeding this year. And that's because of the low price of wheat. I look at Kansas hard red winter wheat, and it's pricing itself pretty competitively into some of the Texas, Kansas feedlots. And even globally, when I talk about China, wheat is pricing itself into the Chinese feed rations as well as imported corn values there. Export and trade, we're going to have the good news there is we're going to have record exports, 100 on international trade, about 194 million metric tons. That's up month on month, and it's up 2.3 million metric tons year on year. At the end of the day, we're going to have about 313 million metric tons wheat stocks left at the end of the year. And I like to boil these down to a stocks to use situation. Some people like to look at it as days of use. I'm a bit old school and like to look at it as stocks to use, about 41.5%. While that's down a little bit from the December estimates, we are growing those ending stocks for wheat. So for wheat, we're in a pretty comfortable situation globally. Just to look at the export breakdown, these are the major exporters. Russia, as I said earlier, is the biggest exporter of wheat coming out of the Black Sea. And if you combine them with the Ukraine, which is at 9%, you got about 30% of the world's supply of wheat coming out of that Black Sea. Key thing about the Black Sea is they have significantly improved their grain quality coming out of that region in the last 10 to 15 years. And it's not necessarily the low quality feed wheat, but they're competing a lot more tenaciously with us into particularly the milling wheat type markets. U.S. comes in at 13.8 and flushes out all pretty close between the U.S., Canada, and the EU. Australia makes up about 10. And then we keep an eye on Argentina coming in there 7 and about 6%. Interesting where wheat is going. Wheat's a bit different than corn and soybeans in that the buyers aren't nearly as concentrated. It's a lot more spread out between countries. Egypt is the biggest buyer of wheat at about 7%. There is some U.S. wheat that goes in there, particularly for milling, but given their geography being close to the Black Sea, they predominantly buy from the Black Sea. Then to spread that around, Indonesia, China, Turkey. China's been interesting. Surprisingly, they've been buying more U.S. wheat this year, and that's on the back of good demand for specific milling quality type wheat. The Chinese population has been shifting from a rice diet to more of a European bread style diet over the last 15 years, and that demand continues to grow as their dietary population or dietary demands shift that. So just to drill down on the U.S. situation in a bit more detail, in our balance sheet, we produced about, and I apologize for having these in metric tons, but when you're dealing in the international matrix, everything's in metric tons, not bushels. We produced just under 50 million metric tons this year. Milling demand's been about steady, 27, just under 28 million metric tons. We have seen a pickup, as I said, in that feed wheat situation, as it's about 3.4 million metric tons. The bright picture has been in the export situation, not only this year, but last year. It's approaching 29 million metric tons. USDA's got us at 26.8, which is up, and I'm sorry, my numbers on this particular slide aren't updated, but the numbers in the matrix are correct. That leaves us with about 22.7 million metric tons for ending stocks. Again, a fairly comfortable stocks to use situation for wheat. And it's the job of the market. Wheat's trying to price itself into the feed ration, particularly for hard red winter wheat. And but when things start getting tight, its job is first price itself out of the feed ration. This is just a look at U.S. wheat exports. They've been declining generally over the last 40 years from the mid 80s, early 90s, but and that's particularly been on the back of increased production in the Black Sea. Little interesting footnote, my first introduction to IGP was back in 1991 when I came up to Manhattan, Kansas to speak to a group of Russians who were some of the biggest buyers of U.S. wheat at that time. This is the ending stocks to use situation with the USDA estimated farm price. Keep in mind, this is the average received farm price that's graphed on there. As you can see, we're tightening the stocks up, but look, they're nowhere near where we need to be extremely concerned. This is the long-term price history going back, and wheat has been fairly stable, and we've been following, as I said, soybean, particularly in corn prices up in the last 12 months. I want to look at wheat by class because this is where things sort of break down. Being soft red winter wheat producers, it is actually the tightest balance sheet of the wheat by class situation. If we look stocks to use situation for all wheats is at 39%, but our soft red winter wheat situation is 35.5%, which is the tightest of the classes. And that's why we're seeing soft red winter wheat continue to stay priced at a premium to the hard red winter wheat situation. The particularly loose situation is the hard red spring wheat. North Dakota being the biggest producer of hard spring wheat. And it's going to be interesting this spring when they come to planting. Are they going to plant soybeans? Are they going to plant wheat? And I expect to see a big shift in soybean acres in that hard red spring area. One thing I want to emphasize in this particular presentation, particularly since I'm talking to Southern Illinois wheat growers, you're tributary to the river system, whether that's the Illinois, the Ohio, or the Mississippi. That wheat production in your area is really key to the appropriate functioning of the CME Chicago wheat contract. You're what's the stocks that are immediately tributary to that delivery situation. And one of the takeaway messages I want you to take from today is it's that export price, it's that world price of grain that sets the floor or the benchmark price where you start from on any given day to price wheat. The domestic end users and millers, they're an important dynamics of the market, but they have to pay a premium above that export price to keep that wheat from going down the river into the export market. So that's it's just your production in that immediate area being immediately tributary to the delivery situation for Chicago is key to having efficient price discovery. One point I would argue on the hard red winter wheat situation, because we have a inland rail delivery for that particular market, I wouldn't go so far as to say that the contract's broke, but the contract is a bit frustrated because of some freight spreads and some rail issues that I think is discounting that hard red winter wheat futures price a bit because of those particular dynamics. Moving on to the soybean situation, looking at the world soybean balance sheet. Again, we're going to have record production of soybeans this year globally, 361 million metric tons. While it was down from the USDA report last month, it's still a record, but it's up 24.5 million metric tons from last year. Consumption is also going to be a record, 343 million metric tons, and that number was up last month by 47,000 metric tons. And up year on year, a whole 13.5 million metric tons. We're seeing quite good demand for soybeans. And in the crush, we look at both oil and the meal, and we're getting a unique situation where both oil and meal are lending very good support to the whole oilseed complex. It's just meal prices are strong or oil prices are strong. But in this current situation, we're seeing good contribution from demand from both oil and the meal complexes on that. Exports of soybeans, again, going to see record exports out of the U.S., just over 169 million metric tons. That was up last month, and year to year, it's up about 4.4 million metric tons. And most of that's been driven by recovery in China. China is the biggest buyer of oil seeds, and the recovery in that African swine fever situation and the feed demand is really driving that. And we're going to see that both in corn and soybeans on that. And I'll talk to that just a bit later here. Soybean ending stocks internationally down to 84 million metric tons. That's given us a stocks to use situation of about 22.8, which we would consider fairly comfortable. However, the situation is quite a contrast when we look at the U.S. situation. World ending stocks, this is broken down by country. And the interesting thing with the soybeans, two major producers, U.S. and Brazil, one's in northern hemisphere, the other's in southern hemisphere. So we get this dichotomy and the seasonality. And as you can see, basically the world buys soybeans from the U.S. from September through till March, and then the last half of the year they switched to South America. If you'd zero in on the ending stocks for the U.S., it's quite tight. Whereas we've got Brazil and Argentine production coming on in a month, and it's always a big shift in the logistics and the supply chain when we're going to make that shift. With the dry weather, the late planting, the strike situation, the number of issues, that shift in the supply chain to South America has been delayed a bit and remains a bit uncertain. And so we've had significantly more buying coming out of the U.S. for a longer period of time than what we would say in a more normal year. Drilling down in the U.S. situation. Production this year, and sorry, I've got a bit of an error in my number there. It's 112.5 million metric tons, up about 1 million metric ton month on month, up 15.8 million metric tons year on year, which is fairly a significant jump, and that's on the back of the prevent plant and weather situation last year. Domestic demand in the U.S. for soybeans has been at record levels. We're seeing very, very strong crush margins, and that's on the back of good demand for both oil and meal, not only domestically, but also internationally, as our exports on both those have been quite strong. Our exports are going to be about 60 million metric tons, 61 million metric tons. Again, USDA keeps revising that up a bit, and that's about 15 million metric tons higher than last year. And that's on the back of China's recovery, and not only China, but across all of Southeast Asia, their recovery from the African swine fever situation. Now, we're going to run our ending stocks down to pretty low levels. At the end of the year, we're going to look at about 3.8 million metric tons. This is going to take our total stocks to total use down to about 3.1%. Now, this is a pretty tight situation, and we're looking at one of the lowest levels we've had, go back to about 2013. It's still a little bit tighter, but that's what's really putting a lot of uncertainty in the soybean market, and we've seen price responses to that. This is my stocks to use graph. I go back to 2007 and 8. As you can see, 3.1% stocks to use puts me on the far left side of the curve. Your model starts to break down when you get out to the edges, and we're definitely on the edges of the price situation. Having soybean prices, and look, again, this is the weighted average farm price, not the Chicago price. Having prices up to $13, $14 level is expected. I'd also suggest it's just a little changes in the fundamental situation. So it doesn't take much news to impact either production or demand, and it moves that price quite volatilely. The other thing I want to talk about a bit is the only reason this goes back to 2007, in the wake of the global financial crisis and the relative change in the value of U.S. currency, our older models sort of broke down and didn't work very well. Well, I'd actually suggest we're in a similar type situation where we're printing a lot of U.S. dollars. We're having a shift in the relative value of the currency. And I put a big question mark over my stocks to use models at the moment, because we're seeing a similar shift to what we saw back in 2007 and 8, which you go back to the 1970s when we floated the dollar, you get those similar type of dynamics as well. So it's adding to, I guess, dropping my confidence in these pricing models. As we reached above $14, we dropped back, saw a significant retracement last week. We're seeing some recovery early this week. I wouldn't be surprised to see those values go back above $14. Looking back to when we had similar stocks to use in 2013, we saw beans above $16. Going back to the GFC, we saw values again above $16, and I don't think that would be a surprise, but it's quite volatile. Things can rally fairly quickly. They drop off even faster. So if you have some pricing opportunities out there, you definitely want to take advantage of them. I want to shift to the corn situation here for a little bit before I go to questions. Corn, sort of what I probably know the best. World corn production's 1,134 million metric tons of corn. This is still world record corn production, even though we brought this down about 10 million metric tons month on month. It's still about 17.5 higher than last year. So we're seeing record production of feed grains. Feed demand has been driving this situation, and the return of the consumer to animal products, not only in China and Asia, but I'd say internationally, we're seeing a real strong growth in the animals, a number of the animal sectors. Also, while the food, seed, and industrial complex has been a bit of a concern, it's been surprisingly resilient. That's predominantly dominated by ethanol in the U.S., 420 million metric tons going into food, seed, and industrial. And the way that sector's structured, particularly with the mandate and the requirement of ethanol going into it, the profitability margins, while they've been narrow and negative frequently, the industry does a good job of protecting those margins when they do become positive, and have stayed relatively fairly strong. Looking at our world trade and exports, corn exports have made a significant recovery this year from last year. We're going to have record international trade, just under 184 million metric tons. That's going to leave the world with about 284 million metric tons of corn at the end of the day, taking our stocks to use down to about 24.8%. That would appear to be relatively comfortable, but big unknown in this equation about China, which I'll talk to. Interesting thing, put this in perspective, the U.S. is the U.S. biggest producer of world corn, 360 million metric tons. China is the second biggest producer at 260 million metric tons. And so they sort of dominate that whole corn complex. Consumption this year is going to be at a record situation. What I wanted to highlight here, the two biggest consumers of corn are both the U.S. and China, but they're also being the biggest producer as well. They make over half of the consumption in those two countries. Drill down a bit on the China situation in meat. We're seeing a recovery in particularly their hog herd, but also growth across all their meat sectors, particularly poultry, dairy, and aquaculture, and the beef in there is dairy, not what we would think about as beef. A lot of the beef is imported. One thing we've been watching closely is the imports, and USDA put this out last month. We sort of expect meat imports to drop off as their domestic production recovers, but notice their consumption is increasing as well, even with record high prices for meat and meat products in China. I'll skip that one. This is world ending stocks. What I want to bring to the highlight here is on corn for ending stocks, China, by USDA numbers, holds about 2/3 of those ending stocks, 67%. And there's a big question mark over to, are those stocks really there? And the trade would suggest that they're not. 186 million metric tons of ending stocks sitting in China is just, I think, a bit overstated. Just touching base on export situation, these are the major exporters. U.S. is roughly over 1/3 of that, and we're going to have record exports this year. The big consumers in there, the big buyers of corn, to keep it in perspective, are the EU, currently estimated at number 1, at 10%, China at just under 10%. I would be so bold as to say by the end of the year, China is going to fill that number 1 position. I expect their imports to be well over 20 million metric tons. At the moment, they're about 17, and that's basically all from the U.S. And I could see that easily go over 20. Looking at the U.S. situation, production, 360 million metric tons of corn in the U.S. down month on month. The USDA brought that down sharply in the last estimates, which has caused a bit of a stir, but it's up year on year, about 14.3 million metric tons, given our production problems previous year. Exports, as I said, are going to be a record at 161 million metric tons. On the corn, ending stocks are going to, exports are going to be 64.7 million metric tons this year, bringing our ending stocks down to about just under 40 million metric tons or lower, or about 12.9%. At 12.9%, it's getting pretty tight. Sorry, that's on a domestic stocks to use. On a total stocks to use, it's going to be 10.7%, which is getting very, very snug, to a point where the market's going to have to price some of our demand out. Okay. This is our corn export pace. Our export pace has been just pretty much on par. We're going to have to play catch up here a bit, but the good news about exports, there are a big number of forward sales already on the books, which will extend well into the marketing year. It gives us a high degree of confidence in this export program. And as the soybean export program backs off here in the next few weeks, as it shifts to South America, we're going to see an increase in those corn export numbers. Just to highlight the China situation. Last year, China was our 21st largest importer. Today, year to date, we've had about 12 million metric tons of corn being shipped or committed to China. Mexico comes in second. And the number I want to talk to a bit is this unknown number. We've got about 7.7 million metric tons of unknown sales. I would suggest probably conservatively half, but more than likely 2/3 of that number will be destined for China. Looking at the price outlook, corn has showed good strength. It hasn't rallied quite as sharply as soybeans. To some extent, it's been chasing soybeans, particularly in the new crop number, because it needs to compete for acres, and it's going to be interesting in the next few weeks how it sorts that out. I'd say at the moment, soybeans is probably winning the new crop battle. We've seen some good strength on that. Looking back in previous years, particularly using 2013 and going back to 2008-9, I actually think we've potentially got more upside for corn, and that's going to be driven by the continuation of Chinese purchasing, and if we continue to tighten up that balance sheet situation. Just to put the price of corn in China in perspective, we saw March futures in Dalian rally above the 29 yuan mark this month. 29 yuan per metric ton equates to $11.37 a bushel in U.S. corn. So there's quite a gap there between the value of corn in China and value of corn in the U.S. Keep in mind, the Chinese government, the Chinese economy is not a free market economy. It's a centrally controlled economy, and it's driven by Chinese policymakers, and there's significant import quotas as well as tariffs that limit the flow of grain in and out of that country. And it's not quite what we always think it is. Anyways, today, if we take China's existing commitments and add on the unknown, say half of it, that brings China's total corn purchases out of the U.S. to 15.5 million metric tons. If we call it 2/3, it takes us up to 16.8, just 17 million metric tons, which the USDA currently has us slotted in at 17.5. And as I said earlier, I think that number is going to be well above 20 by the end of the year. Looking at the ending stock situation, just to talk to this, if China had 190 million metric tons of ending stocks, I don't think they would be buying corn the way they have been. I think any trader would suggest it's probably half of that. And I think the people that are actually in the market trading that would suggest it's probably under 50, if not closer to 40. Some of my good contacts in China are suggesting that total corn imports into China could reach as much as 30 million metric tons this year. To put that in a bit of perspective, China's where they're at with corn, where they were at with soybeans 25 years ago. They don't have the resources to produce enough grain, particularly if they want to consume the animal products they want. And they're struggling with the decision, do I open that market up and import more feed grains? Very similar to where they were with soybeans 25 years ago. Today, they buy 100 million metric tons of soybeans, and that's basically nearly 60% of the world trade goes into China. And I think probably in a more rapid situation than we saw with soybeans, we could see the same situation evolve there for the corn situation. Its impact on wheat, it's both corn and soybeans here that's driving that wheat price. Corn particularly, as wheat has to stay priced out of the feed ration, and that's what's going to be driving our prices going forward. So on that, wrapping that up, a lot of numbers pretty quick there. Apologize for the couple of errors in there. I'll go back and correct it and resend it out to you, Mike. Happy to answer any questions and drill down on any of the subjects or issues you'd like to. So I'll turn it back to you, Mike.
Thank you, Guy. I'm going to get control back over or get it more opened up there. There I am. I'm at the top of the screen. You're on the screen. That's great. We're going to open it up to questions from our audience. I'm going to start out with a couple. The biggest thing I walked away with here, they say, like, what are the key takeaways? You're saying more upside potential going forward in the corn market than in the soybean market. Is that correct?
Yeah, look, I think we saw that last week. The trade started to get a bit comfortable with, particularly as rains came across in that South American production. And I think they're comfortable with the fact the soybeans are there and they're accessible. It's just a matter of logistics when they're going to switch. Now, that's not to say that soybeans are still tight. And if there's a problem, whether it's a strike situation, a shipping situation, production comes in lower than expected, we couldn't see a big pop in soybeans again. But I would suggest as harvest starts to come off in South America, and the way these seed guys have these commodities pumped up, they always come in a bit better than we anticipate. Corn, I think, is increasingly going to be the focus going forward.
On that note, so one of the things, and you may have covered this, and was that I saw a tweet or something by a trader saying that over the last 5-6 years that most of China's corn purchases have come from the Ukraine, and that we've been kind of saved by Ukraine not producing, not exporting, not shipping to China. And is there any fear there on your part that Ukraine could have a good year and take that market back away from us?
Look, the Ukraine's key, that whole Black Sea export, which is Russia and the Ukraine, is it's freight advantage to China and Asia. They had some dry weather last year. They lowered their production number, shifted back into your drier land commodities such as wheat, barley. Look, there's always that potential, and there's significant production potential out of that Black Sea. But I think coming back to the U.S.-China trade agreement, I think China realized they were going to have to buy a large volume of commodities anyways. I don't think they were necessarily giving anything up. So when they agreed to phase one part of the trade agreement, it was, it's in our plan anyways. So yeah, I think we need to keep a close eye on that Black Sea situation. What's driving that Black Sea situation is we're seeing this food inflation, not only in Russia and the Ukraine, but a lot of places around the world. And increasingly countries are becoming concerned, I need to control those domestic food prices, because that hits their population pretty much immediately. And and countries are increasingly willing to slap on an export tax or limit exports in some way, particularly when it comes to food grains like wheat and rice. Less so in corn and oilseeds, but look, they're starting to do it.
Thank you, Guy. I'm going to turn it over to Claire Weinzierl. She's got a question in the box, and then I've got a follow-up question if there's no others, but she's got one that's come in. So go ahead, Claire.
Absolutely. Thanks, Mike. And I'd just like to remind the audience that if you have a question, please direct it to the Q&A function at the bottom of your screen. I have one question here that says, should we look at stronger prices going into 2022 for corn and soybeans?
Look, yeah, I remain cautiously optimistic for a number of reasons. It's going to be, look, the world farmer producer has a tremendous capacity to respond to higher prices. But I think what we're seeing in this rally, it's being demand driven, and demand's always a bit harder to quantify than the supply side. And what keeps me optimistic are a number of things. One is we're seeing the demand from feed not only come from one sector of the feed complex, but we're seeing strong demand in pork, beef, poultry, aquaculture, and aquaculture is a significant growth area, particularly in Asia. So across, and dairy as well. So across that whole complex, very, very strong growth. Also, we're seeing it, and it's probably more reflected in the oilseed situation, where we're seeing strong demand for both oil and meal. And so there's a number of things happening there, as well as on the macro level. This currency, and it's more of an exchange rate issue. We've seen commodity price rallies as we see a flight to security. Not most recently, we saw that in 7 and 8, where people wanted to hold something as a risk, as a hedge against inflation, and agriculture commodity assets do that. I think we've already seen that in farmland, from what I hear that's trading in Illinois. We're seeing that internationally elsewhere, and that keeps me pretty optimistic on commodity prices across the board.
Thank you, Guy. Claire, do we have another one? I've got a question if you don't. Oh, she's got another one just came in. Go ahead, Claire.
Yep, we just had one more come in. Will a higher market develop for conventional soybeans and corn? And he's talking about non-GMO grain.
Yeah, look, the non-GMO versus GMO issue is interesting. I think my view on that has always been, well, let's label it and let the market sort it out and let price sort it out. The thing that your consumer wants is most of the time the consumer says, well, I want the GMO product, but I don't want to pay a premium for it. And I go, well, sorry, they're two different animals. You got to pay a premium, and you got to pay a sufficient premium to pay the extra cost to go through the supply chain. The whole U.S. supply chain is built on bulk fungible commodities. It handles number 2 yellow corn. It handles number 2 soybeans. And they're part of the reason elevations in costs going through the supply chain is a bit higher for wheat. It's because for wheat, I have to segregate it for protein, particularly test weight, a number of other factors. And so there's an extra added cost to that. So short term, I think there's going to be good demand there, and it's probably coming more from the industrial sector, biofuels for soybeans, biofuels and feed for corn. But the consumer is going through an interesting decision situation, and we just need to get good price signals through the supply chain. And I think with a depressed economy, lower disposable income in the wake of this COVID situation, consumers probably aren't as discriminating as what they used to be. They're probably going down to a lower cost domestic food situation. But we haven't defined that yet. This COVID's really shifted a number of demand curves, and we just don't know exactly where they've gone.
Thank you, Guy. I've got one last one. I know we're getting up at the end of the hour. I want to remind our audience, we do have CEU credits coming. You're going to have to wait until we put that slide up. That will come pretty shortly, but I've got a couple things I wanted to do, but I've got one last question with Guy. Then we'll do some thanking and acknowledgement of our sponsors. Then we'll go to that CEU credit slide. And those of you can have your phone ready. And when I put that up, I'll leave it up there, and you can go in with your phone, and you can use your scanner on your phone to take a picture of that IRC code and then get credit for this. My last question, and then we'll go to the thanks and acknowledgement. But Guy, do you have any for our wheat producers out there? Something that what I'm asking about is, have you consistently seen or have seen frequently with our grain farmers in general, but particularly we'll say our wheat farmers and double crop, anything that they probably should or consider tightening up on in terms of pricing their grain or hedging their grain or using puts and calls that you feel that they're kind of underutilizing, that they want to at least think about, put a little more focus on this year, something that they can walk away with that might improve their overall pricing strategy?
Yeah, look, in these times of high volatility, and when you have significant opportunities, you've got to have a fairly creative and forward-looking pricing strategy in place to take advantage of that. And the difficulty is in these types of situations, the cost of options because of volatility gets fairly expensive. But it's sort of like you don't need car insurance if you're not going to have a wreck. If you got a 16-year-old kid at home, you need car insurance. It's going to cost you a fortune. If you're in my age, Mike, the premiums get pretty cheap, but you don't need it quite so much. So that's interesting. Just talking with a colleague here at K-State, they're starting to work through these farm programs, and he was taking a look at, well, with the current farm programs do provide some opportunities at cheaper than the cost of an option to manage your income or to secure those forward pricing. And so there's a lot of different alternatives there. And it's not like one strategy fits all. You're really going to have to look down at your own farming operation, your own appetite for risk, your own capacity to understand the markets and who your market consulting is. And look, it's got difficult enough. You need a market advisor coming alongside to help you develop some of these more complicated strategies, or at least make the comparison between the government program versus a market alternative there. But look, you've got some significant opportunity here going forward. And don't let this inverse in the market. When you're looking at soybeans, you've got a $2 spread between old crop, new crop. Everybody wants the old crop price for the new crop bean. Just don't get distracted by the nearby price versus the forward price. If we get new crop beans about $12, let's not be silly.
Thank you, Guy. We are down to the last 7 or 8 minutes here, and I don't want to lose people's opportunity to use the IRC code. So those of you who have sent in some questions we did not get to, thank you very much. Feel free to email me those questions. And if you don't have Guy Allen's email address, and we can follow up with you about those. Guy, would you be willing to do that? There's just a couple market questions.
Yeah. Look, that would be good, Mike. That would be definitely good. Or if you could distribute them through the group after we answer them, so everybody can appreciate the dialogue. That would be fine as well.
Maybe we'll get to them before the very end of the hour, but we do have a hard stop here at 5 minutes. So at this point, one thing I want to do is just thank everybody that helped support this. Not only thank Illinois Soybean Association, their support has been fantastic in helping to make this happen, and also Charlene Blary is our administrative assistant. So thank you all for what you've done. I want to thank Alan, Mr. Guy Allen, as the senior economist with the Kansas International Grains Program. Thank you, Guy. You've done a fantastic job here, and it's been really interesting. Will you have a slide deck that we'll be able to share with people, or can you do that? Or?
Yeah, look, I noticed a couple errors I had in there on some numbers. I'll correct that and send it to you in PDF format. And if you want to distribute that to the group, that would be fine.
Okay. At that point, let me jump over to the slide with the sponsorship on it here. So I want to mention, again, our platinum sponsors. These are longstanding sponsors. They've been with Illinois Wheat Association for a long time. All of these sponsors have been. So I want to make sure everybody understands that. This is a continuing support from Agrimax Seeds, from ADM, from Corteva, and from Illinois Farm Bureau as platinum, and our gold sponsors as well. Growmark FS with their new wheat seed, Central Life Science, and as always, the support we've got from Seymour Milling Company down in Teutopolis with their milling plant. So thank all of you corporate sponsors for that. We really appreciate it. Let's see, and I will then do a stop share there. And I'm going to go ahead and click over to the IRC code. So those of you who have been hanging in there with us and you'd like to receive CEU credits, take your mobile device out. If you have a scanner app, there is an app on an iPhone, at least, that's a scanner, and you can just go right and it'll pick up that IRC code, and you'll get credits immediately. Or you can take a photograph of this, or you can email me. My email address is there, mdoherty@ilfb.org. And between Charlene Blairy and I, we'll make sure that you get proper credits. We'll get you signed in for that. So I'll leave that up there for a second and let them take that. And while they're doing that, we still have a couple minutes. We can jump back to a couple of those questions. I'm going to turn it back over to Claire. Claire, do you have a question there you'd like to read off?
Absolutely. Here's another question that says, you mentioned also an effect on sorghum acres. Canada has replaced many acres of wheat with canola. Will this happen in the US?
Look, the sorghum situation, looking at Kansas being the biggest sorghum state, having a close look at that. Look, yes, definitely. I think old crop sorghum's this is at the Gulf, is over $2.30 premium to corn. New crop at the Gulf is already better than $1 premium to corn. Big incentive to plant sorghum acres, particularly since it's been dry. New crop values here are probably 50 cents premium to corn, could be up to $1. So yes, I could see a 20% increase in sorghum acres. And I think the limitation on that is seed availability. I haven't been able to nail that down. Here in Kansas, it'll replace corn acres, not soybean. So it'll substitute for corn. But Texas, Kansas, and Oklahoma, your sorghum producing states, I think we'll see a big shift. Yeah. But look, it's a precarious market. All that sorghum's going to China. It's priced out of the ethanol market. It's priced out of Mexico export market where it's going for feed. It's all going to China.
Thank you, Guy. I want to jump back in, Claire. One thing I want to mention is that Thursday, we have a panel of USDA state office administrators. So we've got the head of RMA, Brian Frieden. A lot of people may be familiar with him. He is the RMA state director for Illinois. So you can have questions asked directly from state administrator. We have two administrators, regional and assistant administrators from FSA. All of these are in Springfield for the most part, and they will be available to take your questions. So that's our panel discussion Thursday at 11 o'clock. And at that point, we're almost at the end of the hour. So I'm going to say thank you all. It's been great. Thank you, Mr. Allen, and thank you, Illinois Soybean and Charlene and everybody else for making this happen. So we'll see you Thursday.